discuss revenue from contract with customer in advanced level in this video. So in this video, we are going to learn about the cost of contract, whereby certain costs that happen before the contract or during the contract, this cost are we going to recognize immediately in our SOPL as our expenses, or we call it as cost, or we should put it under our SOFP and amortize it accordingly throughout our so-called the period of the contract. Second part will be on our contract modifications, where if we realize that there are certain things in our contract being modified, will these particular modifications resulted a new promise, or it won't? It's just a rectifications of the existing performance obligations, or we know it as promise. And last, we will look at fields specific guidance under IFRS 15. So now, let us start with our cost of contract. So before we talk about cost of contract, we can actually relate something that we have actually learned in our financial accounting lower paper or intermediate paper previously. So when today I'm telling you that I have a project, if in this project, I actually quote other people like 100 million. And the cost associated with the particular contract is actually 60 million. And I can easily conclude that my profit from this contract is 40 million. And this contract is going to run for 4 years. Assuming we are not using the percentage of completion as a basis, we are just looking at these 4 years, and the progress of these 4 years is actually equally the same. Like in year 1, I'm going to expect it to complete 25%. In year 2, the progress will be another 25%. Likewise for year 3 and year 4. So ultimately, when I arrive at the end of year 4, it will be 100% full completions. And according to this particular trend, how are we going to recognize our revenue? Assuming it's equally for 4 years, so I know that this is year 1, year 2, year 3, year 4. So I will draw a timeline, and you know that in the end of year 1, year 2, and year 3, year 4, we will need to do certain accounting adjustment. So the revenue happened in year 1, we know that it's a 100%, 100 million of the project price times 25%. So I'm going to recognize my revenue 25 million. So I will debit my contract asset, credit my revenue. Likewise, year 2, year 3, and year 4. Therefore, we can fully recognize the entire project by the end of year 4, 100,000. And this 100,000 will be split across the project period. Likewise, to actually achieve this matching concept, we want to avoid we over-record our costs in other period or during the period. So we will need to follow matching concept. And matching concept tell us that same proportions like what we recognize in revenue, our cost, we are going to use 40 million times 25%. Likewise, for others, also the same. And at the end, we will fully recognize the 60 million. The cost is 60 million. We will fully recognize the 60 million, which is our cost. Therefore, we have fully recognized everything. So the whole idea here is that we will need to follow matching concept to match our costs to our revenue across the period. But what if now, if I additionally spend an additional cost, additional cost of this 20 million, am I going to charge it directly in 1 year, or I'm going to split it for the 4 years? Same logic. We will split it based on the 4 years. okay, or 25% equally. And we will achieve 20 million fully record for the 4 years. So this will be the additional cost. So this logic, we learn financial accounting, we know we are doing matching concept. And the same principle you will observe in contract cost. So the contract cost part 1, we are looking at if today we are spending certain costs in the upfront of the project or during the contract that we develop certain things. Is this cost is going to expand off immediately in our SOPL, or are we going to keep this in our SOFP asset and we amortize accordingly based on the contract period or the progress percentage? And this part will guide us on this. So the purpose of this part is to evaluate whether certain costs that we spend related to the contract, are we going to expand off immediately under SOPL, or are we going to amortize over the contract period? So now, the guidance here given is the cost of obtaining a contract, meaning to say in upfront, if we spend this much of money, if we spend this much of money, are we going to keep it or expand off immediately? This will be depending on whether we are going to recover back the money or not. If let's say we are going to expect to recover this associated cost from our customer, meaning to say in layman term, it is related to one PO that you are going to satisfy in future, so-called the promises that you are going to give it to the customer, you are going to recharge back to them, then we will recognize it in our asset and amortize accordingly. Like for example, if today you are actually paying some things, okay, so we extend this, we keep it as a separate scenario. If today I spend a cost and this cost is like what? It's like my advance payment, okay? I actually spend this money and I need to spend it to actually lock the project, for example 200k, and the project will be run for 4 million. I cannot charge this 200k immediately in my year 1 as an expenses, cannot, because this will distort my entire P&L for year 1, because this cost is actually by right related to the entire project life, which is 4 years, and therefore I should keep it under my asset 200, debit by asset, credit my bank, and at the end of year 1 I will recommend my expenses by 50. So meaning to say my asset now become 150. Another year gone through, my asset now become 100. Then another year complete, my asset now left with 50. And at the end of year 4, it will be 0. So I will gradually amortize. This is what we say. So as long as you spend this cost, it's related to the project in the inceptions of the contract, and you expect that this cost is going to recover back from the customer by recharge them, okay? Or it's related to the following few years contract life cycle, and we are going to put it under asset first, then we will amortize accordingly. This is to align with the matching concept. Or if certain costs that you spend during the project, cost of fulfilling a project, for example, this particular case, normally we can link to contract modifications. Maybe because you want to spend certain money, okay, because of customer additional request, and then you spend certain money, right? And this money you are going to recharge back to the customer, and it's not actually it's not within the scope of another accounting standard. It's purely this accounting standard and related to the contract or any contract that you are able to specifically identify that will be on the future, generate and enhance to satisfy your future performance obligations, something that you're going to promise in future, like additional PO that from the modifications. And last one, must be expected to recover. Then if you can fulfill this particular cost, you can also recognize as an asset, gradually amortize, else expand off. Therefore, the criteria during the contract when you spend is very critical, because you must be able to justify these 3 areas. I give you one very simple example later. And the second part will be on the contract modifications. So now, a usual typical example that I always give in my class is these modifications. So assuming now we have a clients, okay, you have a clients where this particular client asks you to renovate, okay, you need to do renovations for your clients, okay. So you need to do renovations for the clients, and these clients will require you to actually renovate the central kitchens. Just a moment. So this central kitchens is actually 3 floors. Just an example lah. So we will have a 3-floor building, and the central kitchens is actually at the ground floor, and you have a cooker hook and the stove for you to do the cooking things, and the piping, a lot of things, okay. So maybe this floor is something that you promise to give it to your clients, and originally the cooker hooks that we actually promise to our customer, or the customer ask us to do, is something like this. So this is the cooker hook that the smoke will be exhaust out from here. So this is so-called the original project. Maybe we caught them, the sales is 100 million. But if let's say the existing contract having a cost of maybe 40 million somethings, so we are going to take this project like 2 years example. So meaning to say, assuming there are constant progressions, so each year we will recognize 50 million of the sales and cost 20 million each year. So this is the original project. And now you actually come into a situations whereby there are certain authorities, okay, tells you that this is not allowed. So you need to modify. So a modifications is needed by dismantle this one and extend the cooker hooks, the exhaust hood to the top level of the building, so that the smoke will be coming out from here. So these modifications actually need to spend extra money. It's not something that free. So from these modifications, right, you will need to quote an extra things to your customer. Maybe you need to quote like 40 million extra sales, and the associated cost is 10 million example. On top of that, there is a penalty cost on this particular original promise that is something that not allowable by authorities, then put on the penalties. And there are some general expenses such as the dismantling and all that things. So the cost 10 million is for this 40 million, like you extend up, and the penalty example is 5k, and the general expenses is 10k. So questions. We know that this part is going to link it to the next particular part, which is contract modifications. We are going to judge whether these contract modifications resulted a new PO or is a change of existing PO. Okay, so this is one thing. Whether this 40 million, how are we going to record? We will look at the second part of today. And concurrently, we will have the first part, which is on this 10 million, 5k, and 10k. These 3 items will be fall under contract costs, whereby should we expend off, or we should keep under asset and amortize accordingly. I think it's quite clear when we look at here. must be something that related to the contract, must be something will generate and enhance future satisfactions of PO and expected to recover. So these things, 10 million for sure will related to the future PO, which is this one. Therefore, it should be carried out as an asset and amortized accordingly in 2 years, and then you can put it gradually charged to your SOPL. But the problem is this penalty, 5,000, and general expenses. General expenses, something specifically highlighted in IFRS 15, you shouldn't put it under your asset. You should recognize under expenses immediately, because something that is not enhance your future satisfactions of PO. It's just cleaning up the existing so-called the old design. And the penalty is also related to the old design, doesn't related to the future PO. Therefore, these two costs we will charge to expenses immediately, whereas this we will keep it under our asset, amortized accordingly in the following 2 years. So this is the logic of your contract cost under the first part. And second part of today, we will look at these contract modifications. And contract modifications sometimes can be very difficult, because in here we can actually see there are a few scenarios. So the purpose of this particular section is for us to evaluate the case, whether these modifications will result a new PO or a modifications of existing PO, or is terminating the old contract, creating the new contract. So we will need to look at it. So we will judge the modifications happen in here is either change in scope, maybe your scope is being changed, expands or reduce, something like that. Price, either one or both, which create existing rights and obligations. So like this one, these particular extensions of the exhaust code is actually so-called the scope changes. And we will need to judge whether this scope changes is an amendment to an existing promise or is creating a new promise. Now, these modifications must be approved by both parties, okay? Else, it is still applying to the original contract. And we should judge the contract whether it separately created a PO or not. If let's say from the contract, we will have additional promise and the promise is distinct, something that they must buy it separately, it's not under one contract. And bear in mind, now we are doing central kitchen, okay? Normally all these things come together. This exhaust hood will be together with this cooker hood. And the price increases by the amount reflects stand-alone selling price, okay? So in here, if we are able to satisfy these two PO, it is a new PO and we will account it separately out from the existing contract. It's a new single PO. And if it's just a modifications or adjustment to an original contract where remaining goods and services, okay, is distinct and not distinct or combined or both, what are the treatments? So let's talk about this particular exhaust hood. Okay, so if you are unable to judge this one, I give you one labeling. This is my A, modifications of this exhaust hood. And I give you another example, B, and extensions of tents where you might need to open up a request. Okay, a customer requests you to install a fan in here, extensions of the tents or all the things. Okay, so this B again is an extra contract. So if this extra contract costs you maybe 20 million, okay, maybe 20 million, and you need to spend a cost of 5 million, then A costs you 40 million, B costs you 20 million. I mean, cost is the customer cost, okay? The selling price to customer A is 40 million. Customer you sell them, B is 20 million. So is an a modifications to existing contract, B a modifications to the existing contract, or both of them are creating a new PO. I think it's quite obvious that this part is not central kitchen, whereby it will create a new promise, a goods and services that is different from the existing contract. Therefore, this part will be a new PO. But when we talk about part A, which is on the extensions of this exhaust hood, originally is like this, a U-shaped. But now we extend on top of the top layer. Therefore, it is an existing PO. And there will be a respective adjustment. So like extensions of the tents and all the things is a separate contract. We will account it as a new PO. The modification of original contract here, modified. And if these modifications, the remaining goods and services are distinct, not distinct, then what is the case that we are trying to see in here? Is either is a distinct or not distinct. So we will need to look at the remaining goods and services. So the remaining goods and services meaning to say these red color extensions. So if this red color extension is a brand new things compared to the old design, then it will be fall under terminations of old contract and a new contract will be coming up. But if, let's say, the remaining good on services are not distinct, meaning to say they are linked together with the old one. I tell you already, the cooker hood fire here, the exhaust will be going up. And therefore, without the extensions of this, these two things cannot function. Therefore, they are closely related to the remaining goods and services. And this scenario will be fall under not distinct. And we will need to follow cumulative catch-up basis. But if it distincts, then this old contract will be terminated. It's not from this old contract terminated and a new contract will be coming out. So I would like to give you one example on this. Okay, for example, if you sign a contract, whereby a cleaning services contract, and this cleaning services contract in year 1 you need to pay 10,000, in year 2 is 10,000, in year 3 is 10,000. Okay, and these cleaning services, they are same pattern of promise, therefore they are considered one single PO. Then now you are still in year 1, but during the mid of year 1 you decided, hey, I want to extend year 4 and year 5, and these extensions will cost me 12,000, and these extensions will need to expand the so-called cleaning area. So questions, the extensions 12,000 that you're going to charge to customer in year 4 and year 5 is resulted a new PO or is an amendment to an existing PO. So I mentioned you have actually expanding the cleaning area. Therefore, these particular things that resulted from here, okay, they are not an additional promises or good or services. It's still cleaning services but expand the scope. Therefore, it's not this. So it's over here, modifications. So such modifications is creating a distinct PO that doesn't related to the remaining goods and services, meaning to say that remaining goods and services are distinct or they are related to the remaining. So it's quite clear cut that this 3 is the existing, maybe you just clean up zone A. But 4 and 5, you need to clean up zone A and zone B. So this 4 and 5 can be seems like a new contract. So upon 1, 2, 3 year already over, you terminate it and you're going to start off with the new contract. Therefore, it will be fall under these categories. And this is how we judge, or sometimes can be combined of both. So this is the overview of this part whereby we call it as a contract modifications. And the treatment of new PO is very simple. We just use the standalone selling price and evaluate it. If there's a lot of PO, you allocate it by using the TP, using the standalone price, allocate the TP to each PO. But this cumulative cash-off approach is actually something that might be new to you if you first look at this video. So if based on the existing progress, maybe your contract start from 1st January 2026 and now is 26 July 2026, so almost halved. And we have done 40%. If the new changes of the modifications worth 120 million, so what are we going to do now? So since progress already complete 40%, meaning to say the old PO already recognize, for example, 40% of the revenue, already recognize 40% of revenue. So we will need to do a retrospectively adjustment also. So the new changes 120 million times 40%, we will need to immediately recognize 48 million by debit our contract asset 48 and credit our revenue immediately, because again they are not distinct to the remaining PO. They are related, therefore we can immediately just recognize their revenue under this situation. This is called cumulative catch up. Cumulative catch up for what you have recognized at the past. If at the date of change is 40% done, then you cumulatively also recognize the 40% revenue. So this is what we say a modifications. And we have done the most important two parts, contract costs and contract modifications. Now, let us go into few specifications, specified guidance by the IFRS 15. So now, sales with rights return, sometimes you sales the goods and these goods attached with the rights of return by the customer. So maybe you sell a lot of goods to your customer and the customer having a rights to return back in 30 days. Normally, if we have a past record, we can analyze the percentage of return, maybe it's 5%. So let's say I sell 100 million, so 5% of this 100 million is expected to be returned. I will need to reduce or defer the sales recognition first by debit my sales. My sales originally credit side. I debit my sales return to reduce my sales and I put it under my liability because I have the obligations. The customer anytime might initiate the return. Correspondingly, if I cancel the sales, meaning to say the goods will be flowing back to my entities. And in this case, I will need to debit my inventory back and credit my cost of sales to reduce my cost. Until when this particular terms expired, I will restate back the sales and reduce back my cost. So this is what we say we will need to recognize the rights of returns related to these sales. Okay? Sometimes if you're unable to estimate a percentage and something new to you, but you know there's a right return for that batch of goods, if let's say we close in today, our invoice on today, there are rights of return in 3 months time, we will 100% delay these goods of sales after 3 months. Okay, meaning to say we will recognize a full sales return now, return liability now, and then after 3 months, we will reverse. Only we will recognize the revenue. So the better case is if let's say you are able to estimate, let's say 5%, we will based on the sales 5%, we will do this adjustment. Else, we will identify that batch and then we will recognize it full. And this 5%, right, must be regularly reviewed. Okay, regularly review at the end of each FYE. So each financial year end, we must regularly review it to see any changes or not. keep updating it. So this is what we say sales of right return. And the third part, B, is on the warranty. Sometimes we buy certain things, it provide warranty. Example, buy phone. So if the phone I buy is 5,000 and normally the phone will come with a standard warranty. Standard warranty, we call it as upon specifications warranty, or we call it as a assurance type warranty. So this assurance type warranty, right, we doesn't sell it outside, or we doesn't sell it separately, because when we buy the iPhone 5000, it is coming together with the warranty 12 months, and it's not a separate performance obligation. Separate performance obligation means what? From one items, you are able to separate it out and sell it to the customer. Like for example, this casing and the iPhone. So we are able to sell it too. But this upon specification warranty or standard warranty, right, is very difficult and we don't sell it separately. Okay, because of law or because of the commercial expectation. Therefore, not a separate performance obligation. Therefore, it is nothing to do with revenue. We will need to estimate the warranty according to IFRS 37 provisions. We will debit the expenses as warranty expenses and credit the provisions for warranty by our estimations. So meaning to say, when the goods transferred already, we will recognize the revenue. But from that revenue, we know we have a specific standard warranty. We will need to recognize an expenses in our account. On the other hand, if we have an extended warranty, something that we can extended buying it. Like for example, iPhone 5000 together with the standard warranty, and the salesman tells you, hey, we have an extended warranty for another 24 months. So each month is $50. So you want to subscribe or not? So if let's say you want, then this particular warranty will be considered as a separate warranty and is considered a separate PO. So you will need to account it. Okay, the sales of phone maybe is PO1, standalone selling price is 5,006, and your PO2 is the extended warranty. So maybe is 1,002, and then we were going to allocate. Okay, so outside, when customer buy it outside, this percentage will be 82% and 17%. Okay, 82 and 18%. And if you sell everything to the customer at 5,600, okay, maybe you free this extended warranty together with phone, or maybe you sell everything at 6,000. Then the real value from each batch of sales, 82% of 6,000 will be 4941.18. That will be your phone value on this project. And then 18%, 1058, will be your extended warranty cost. So this is how we say separate PO, we need to identify their price based on their standalone selling price. So this is the concept. And we have also need to know the relationship between principal and agents. Principal is the one who so-called the masters, and agents we can identify it as servant. So principal, when this kind of arrangement happen, we need to identify who is the principal and who is the agent. Principal, they control the goods. They have the responsibility to fulfill the goods and services or promise, and has the inventory risk. They will bear the inventory risk, and they have the rights to set the pricing. And therefore, they are the ultimate seller. They will recognize gross amount of the entire sales as their revenue. And normally, agents will be paid certain percentage of commissions from the seller. So they are just helping us to arrange the goods and services. We call it as agents. And I think this is quite straightforward. And this relationship we can also see in the consignment arrangements, whereby we will denote the principal as consignor in here and consignee as the agent. And in this consignment arrangement, normally consignor will actually put the stock in consignee places, and the customer will buy from consignee, because consignee maybe their traffic is very good. There's a lot of customer go into their shop. Okay, so I just put there, and then customer will buy. So the issue here is that when the goods transfer from consignee to consignor to consignee, can consignor recognize as their revenue? The answer is no, because consignor, when they put the stock to consignee places, the goods is still belongs to consignor. They will still need to take all the risks, okay? Not control the inventory, and the inventory remain in the control of consignor. So meaning to say, consignor still bear the risk of the inventory. Anything happen is the loss of consignor. Therefore, sometimes in real world, consignor always will request certain level of deposit from consignee to be secure, because I put my stock in consignee place and I feel not so secure. I ask for the deposit. And when can consignor recognize revenue? Only when the goods transfer to consignee and consignee transfer to customer. So when transfer to end customer, then consignor can recognize the revenue. And same, consignor is the ultimate seller. They have the control of the goods. They are responsible on the inventory risk. They have the discretion to set the selling price. So consignee is just help consignor to sell the goods, to arrange the selling. Maybe their administration process is very good, they got good traffic of the customer, and therefore we put our stock in their places. So this is where we call it as consignment arrangement. And these are the few advanced level that we covered under IFRS 15 revenue from a contract with customer. I hope you learned something from this video. Thank you so much.